Good evening, friends. This is the last series of the videos on the stock market, and today I'm concluding it. I hope, like my previous videos, you will enjoy this video and you will benefit from this video. Most of the people often ask in which stock to invest. Well, if anybody knows in which stock to invest, then everybody throughout the world would have been a millionaire or a billionaire, like legendary investor Warren Buffett. So it cannot be said with certainty where to invest. But that doesn't mean that we should invest in the stock market randomly and blindly. No, we should take some precautions. We should just do some little bit of homework. Normally, when we try to purchase what I can call a mobile, we do a little bit of research on its video quality, on camera pixels, on its RAM, on its internal memory, etc. And then we go for purchasing the best which suits our needs. Similarly, when we try to purchase a plot, we do a bit of research. We try to find out whether there is every facility is available in the vicinity, or whether the plot where you are going to construct a house, there is what we can call it is accessible from the main road, etc. Or for that matter, anything. When we try to purchase anything in which a significant amount is involved, we do a little bit of research. We try to consult experts. We try to do our own homework, and after careful analysis and after careful research, we then go ahead and purchase that thing. But when it comes to the stock market, I don't understand why people go and randomly purchase the stocks, taking cue from friend, from any unknown research analyst, from newspapers and others. And as I've told in earlier videos, I can't say all, but most of can be motivated calls. Most of can be such calls in which there is no future. And one thing I have often told you, though brokerage firms are doing very nice job, they are conducting good research, they are spreading the education of investment in the stock, regarding the investment in the stock market. But at the same time, if you observe, most of the brokerage firms concentrate on just trading or short-term investment. None of the brokerage firms will encourage you to invest for a long time. It is simple enough. If they encourage people to invest for a long period of time, they will not get the desired brokerage, and their brokerage may be a pity for a small investor like we. But for brokerage firms who have millions and millions of subscribers, for them a little bit of brokerage means a lot of amount. And now you will say, naturally, you will ask, we don't have the expertise or the knowledge to understand the complexities of the stock market, also to understand its technicalities or how it functions. But you are right. I agree, you are right. But a person with a little bit of knowledge of English language can easily understand certain things which which a layman, which don't need an expert knowledge, which don't need an in-depth research, which don't need some what we call that rocket science. But what you need is a little bit of English knowledge of the English language. And with nowadays we have so much tools available. Google is there, ChatGPT is, YouTube is there. You can easily do the research. You can easily do the research for investing, because even common sense dictates that when you try to significantly invest in certain things, whether whatever it is, a little bit of knowledge we must have about that. In other videos, I told you that whenever you go for purchasing, go for investing in any company, see whether it has good share in the market, whether its products command a good share in the market. And just as I told you earlier there was a paint company who commanded almost 70% of the market. But a very high, very what I should call a very rich person just set up his own paint manufacturing this plant, and they have emerged as a serious competitor for the earlier company. So the price of that shares of the company has significantly fallen, and I expect in the future it will fall further, because its market share has gone down. It will definitely go down if it has not yet gone down, but it will definitely go down because it's a very serious competitor has emerged. So we must have First of all, we must know how much, if we try to invest in a company, we must know how much market share it commands in a how its products command in the market. Second, how is its cash flow? How is its revenue coming? Whether it is good or bad, whether there is demand in its products, and all these little bit of things which I told you in an earlier video. But today I am going to tell you some specific pointers on which you can concentrate. You can just do a little bit of research before investing in any company, especially for the long term of period. First, as I told you, a company should have moat. Moat, for that you can watch a separate video. Briefly, I will tell you the company moat means a company which unlikely to have a competitor in the near future or many competitors in the near future. That's called the moat in the stock market. Second, we must see the price to earning ratio of a company and return on equity of the company, and we must see the how much promoters are how much shares promoters are holding, and whether promoters have pledged the shares or not. These are some of the points. And one more thing, yes, whether the company has a good debit. If company's debits, little bit of debit is acceptable, but if it has more than more debit, then we should desist from investing in that company. We'll just discuss each one of these pointers and a few more pointers in detail. First of all, we must see the promoter's share. If promoter is holding considerable share in the company, that means he has trust in his company and that the company has a good future and he is going to take the company to the new heights. If the promoter shares are falling, then that's the time that we should not invest in that company. Normally, the promoter should not be less than 40% or 35%. If it is below 30%, then we must hesitate invest our whole amount in the company. And another important factor is price to earning ratio. Price to earning ratio normally tells us about the whether the company is overvalued or undervalued. Price to ratio up to 20 is acceptable. Any price to ratio beyond 20 is considered bad. So the price to earning ratio should always be below 20. Similarly, debit of the every because an owner of a company has options. He can he has to obtain the debit. He has to obtain the loan from the banks, but or from any other sources. But debit to some extent is tolerable. But beyond that, it should is considered bad. Normally, for purchasing a stock, for investing in a company, we must see that company should not have more than 0.5% of the debit. If debit equity ratio, if it is beyond 0.5, we should avoid that company. Similarly, another factor is return on equity. Return on equity normally tells us about how much value or profit a company is earning per share. Higher the return of equity, it's considered better. So we must also look for the company which whose return of equity is consistently increasing. One more factor that's called EPS. EPS briefly is called earning per share. So it also indicates profitability of the company. Earning per share, higher the earning per share, better it is. One more factor that's called operating margin. Operating margin normally when the company just all its expenses, salary, wages are paid, or cost on the raw material is incurred, then what is left is called operating margin. Operating margin. If a company has higher operating margin, it's considered better. So a company must always have a higher operating margin. These are some of the factors which don't need an expert knowledge, which don't need any what we call in-depth analysis of the stock market. Although there are many parameters and other things which we need, but for a layman, I think these things are, if a layman just concentrates on some of these pointers, I think it would be better. It would be better for him to do so, because ultimately in the long run these all factors in combination, if any company has all these factors as per the desired parameters, such as debt to equity ratio should not be more than 0.5, or promoters must have higher holding, then we can expect that this company will perform better in the future. And one more factor which I just forgot to mention is that pledging. Normally these promoters of the company, they pledge their shares to obtain a loan, or so normally we must avoid such company which have higher whose share in which the promoters have pledged their shares. I remember there is one company who pays very high dividend, but the promoters have just pledged almost 99% of their shares. So pledging of shares is also bad. We must avoid these companies. Let us hope you enjoyed watching these videos which earlier I had also made on the stock market. And this I conclude the series. In case you want videos, any more videos on the stock market, please tell me in the comments. Or if you want any videos in any other topic, please mention it in the comments. Normally, why I made these few series on the stock market, because people are normally afraid of. They think, as I told you earlier, they think it is a sort of what we call that sort of gambling. No, that's not so. It's a complete science. It's a complete investment. It's a complete business. Warren Buffett, who's mentioned, I have made in earlier videos also. He had no factories. He was just a layman, a common man like us, we people. But he was once, and I don't know in which rank today he falls, but he was once second largest man in USA. And interestingly, he once donated half of his wealth for the charitable cause. So one request is there: please subscribe and share this video. Thank you very much.